Good evening, everybody. This is Ron Wheeler, Manager of Options Trading here at VectorVest, and it's my pleasure to bring you tonight's special presentation, Investing for Income. As we close 2024, now's the time to really gather and think of what we're going to do in 2025 to not only make ourselves better investors, but to look at all of the different opportunities out there to where we can make more money. So what I want to talk about tonight is the idea of investing for income. My primary job here at VectorVest as the manager of options trading is to help our users create an income stream. And tonight, what I want to do is talk about a few of the income opportunities that you can use in the market. So let's talk first about what an income trade actually is. Income trading is where you can profit even if you are wrong on stock direction. It's very simple. I want to create a system. I want to create a trading opportunity where no matter what happens, I have an opportunity to make money. And dividends, for instance. Dividends, I would say, well, first off, let's define dividends. Dividend is a distribution of earnings, often quarterly, by a company to its shareholders in the form of cash or stock reinvestment. And to me, in the investment world, dividends are the purest form of income you can get because you get paid regardless of the stock movement. It's a beautiful thing. And as an investor, I like taking advantage of dividends as well. It's not my primary source of income, but it's a nice bonus when you own a stock. Let me give you an example here. I'm going to switch over to VectorVest, and this is an example of Microsoft. I own Microsoft in my IRA, and what I like about Microsoft is, regardless of market direction, you will get paid quarterly. And you can see it right here on the VectorVest graph. If I go to the lower left-hand side, there's a little dividends column there. I can just turn that on, and you can see the dividend X date where you have to own the stock to get paid on the actual payout date. And you can see quarterly you get paid on Microsoft. Now, if I show you, go back to the slides here, if I show you, this is the dividend payment history of Microsoft. Their annual dividends around $3. And as you can see, I'll get paid 83 cents for every share that I own. Now, dividends are great because, again, you get paid no matter what happens to the stock. The downside of a dividend is you have to own the stock. Owning stock is expensive. It's not something where somebody can go out and everybody can buy 1,000 shares of Microsoft and take part of this. So dividends are great. And if you like dividend trading, you are in the right place because we at VectorVest have a lot of tools for this. If I go to my viewers tab here and I just put Microsoft in the viewers tab, remember, we have the dividend over here, the yearly dividend from Microsoft, the yield, and the safety rating, and the dividend growth. And you can even sort by the yield safety and growth indicator that we have. Furthermore, we can go to our watch list viewer and we can go to dividend payers and we can sort very, very quickly. Here's dividend reinvestments, and I can quickly sort by YSG to find some of the best dividend stocks out there. It's really, really simple. But again, the downside of a dividend is that you have to own the stock, and owning the stock is a very expensive proposition. And you're open to a lot of risk. So if the stock goes down, yay, I get paid $3 a year in dividends with Microsoft. But if the stock goes down $10 or $15 a year, then it's not good. The dividends are not going to overcome the loss on the stock. However, I will say this, as a longer term investor, dividends are a very crucial part of what I do to help create income. Now, what I want to get into tonight is options. That's my bread and butter. Using options, we can strategically use these things to help create trades where we can make money even if the stock does not move in our absolute direction. Now, it's not going to be as fine-tuned as a dividend where you get paid no matter what. But the beauty here of options is we have a lot of advantages. First off is cost, right? It doesn't cost as much to place a trade with options. They're very flexible, meaning we can choose different expirations, we can choose different strike prices, we can use different strategies. And number three, they're limited risk. We can set these trades up in a way where we have a limited risk. That way, no matter what the stock does, if it goes way against us, whether bullish or bearish, we have a fixed maximum loss on these trades. Now, tonight, I want to talk about two different income trades for options. Number one, let's talk about a covered call. And then number two, I want to get into, again, my bread and butter, which is a vertical credit spread. And I want to show you in a basic way how they work. I want to show you in a basic way, how we set them up and why they are considered income trades. All right, so let's do this. I'm going to switch over to VectorVest again, and I'm going to go into my Unisearch. And let's take a look here. I want to go into searches, retirement. And this is one of my favorite folders because these are stocks that are focused on more of retirement stocks. You're looking for, blue chip type stocks, stocks that, have stood the test of time. And one of my favorite scans that I really love running is Premier Growth. I'm a big fan of growth. I'm a big fan of safety. So I like Premier Growth. I like things like this to help me find really the best opportunities. So I'm going to run this search for the close of market October 17th. And this is the top 20 that I see. I see Robinhood, AppLovin, MCore, NVIDIA. You know what? Let's do this. Let's take a look at NVIDIA. NVIDIA has been a really popular stock, a very hot stock recently. But really, if you take a look at any of these stocks, and I'll just graph the top 10, these are stocks that everybody probably wouldn't mind having in their portfolio. AppLovin, Veritiv Holdings, MCore. I mean, these are really, really good stocks. So let's do this. Let's take NVIDIA as an example. Now, what I'm going to do, I'm going to go over to our Options Pro software. Now, you don't necessarily need Options Pro for this, but it is an options software that we have here at VectorVest. It's really good at what it does. I'm going to open up a chart, and let's take a look at NVIDIA. Okay, now, NVIDIA, again, a great stock. It really, really is. Now, if I went out there and bought the stock, okay, stock's trading at 136. If I go out and buy the stock, it's a very simple proposition here. I can make money if the stock goes up. That's it. Simple as that. I make money if the stock goes up. Now, I will say that NVIDIA does pay a very small dividend. It's not great, but they are a dividend company. That's nice. However, let's talk about some options trades and what they can do. So first, I want to talk about just doing a simple covered call. What is a covered call? A covered call is when you buy the stock and you sell a call against it. Now, when you sell a call, when you sell an option in general, selling an option involves an obligation. When you sell a call, you are essentially giving up your right to own the stock at a certain price. So if I buy the stock at 136 and then I sell a 145 call, that means I am allowing somebody to buy the stock for me at 145. Okay? I have to go out there and if needed, I will give up my stock at $145 a share. That's not a bad thing, by the way. However, let's take a look at this on an options risk graph. So here's NVIDIA. Now, the first thing I want to take a look at on this risk graph, and I'll explain the risk graph as we go through it, but let's just take a look at long stock. This is when you own the stock. And this is all I'm doing, is just owning the stock, right? So a risk graph gives you a profit and loss for your position. So right here in the middle is where I would buy the stock. And actually, let me do this real quick. Let me increase this, and I'll make this a different color. That way it's a little bit easier for everybody to see. Okay, so this is, you buy NVIDIA. If NVIDIA, and you'll have to pardon me as the prices change a little bit. If NVIDIA goes up, you make money. If NVIDIA goes down, you lose money. It's as simple as that. There's no technical income opportunity here with this particular trade. Now, what we would do to create that income opportunity, here's what I want you to watch. I want you to watch, and apologize for the graph shaking around here, but I want you to watch that center area right where we are right here, okay? And the reason why I want you to watch this point is because I'm going to go out there and I'm going to add the selling of a call. So I'll go out to November and I typically sell a call a little bit above the stock price. Right now the stock's trading at 130, 137, and you can see why it's jumping around because pre-market trading is already going on. But if I went out there and sold, let's say a 145 call, okay? Now, this is your risk graph for a 145 call, covered call. Now, the beauty of this is, and why is this an income trade? It's because if you take a look right here, this is where the stock is trading, right around here. And again, it's pre-market, so it's jumping around a little bit. Take a look. If the stock goes sideways, you can make money. So right here where my cursor is, this is 136.83, pretty much where the stock is trading in pre-market. Now, over the next 28 days to the option expiration of November 15th, if the stock goes completely sideways, I will make $439 on this trade. Okay? So even if direction doesn't go my way, I still make money. Even better, the stock can now go down, and I want you to watch this solid blue line. This is the money that I could make at expiration. So on November 15th, okay, this is what I would make. On November 15th, if the stock stays above this price, and again, it's jumping around because right now the stock is moving in pre-market, but watch that price right there, right here where my arrow's at. As long as the stock stays above that price, I can still make money. So even if the stock goes sideways or the stock goes down, I can still profit from this. Okay? I'm creating a situation where no matter what the market does, if it stays sideways, I profit. If it goes up, I profit. It can even come down a little and I profit. It's a good situation to be in. Now, the downside of a covered call is it's expensive, right? I still have to go out there and buy 100 shares of the stock, right? I still need to create some sort of a strategic stop for this trade. So if I look at the graph, and I'm going to open up a graph next to the risk graph, okay, I still need to create some sort of a strategic stop. So maybe I place a stop down at 130. Well, at 130, I would still, and if you look over here on the risk graph where my arrow's pointing and I've got the little circle, you're still going to see I'm in a losing situation. Now, the beauty of it is you're not going to lose as much because you're getting premium from the call that you sold. Okay? A covered call, quite frankly, is something that every stock trader should be doing. A covered call is basically getting free money on stock that you already own. Now, some people think with a covered call, well, the downside of that is, I could be called away from my stock. That gets into options. You don't have to be called away from your stock. If the stock goes up and it goes past 145, technically, yes, your stock will be called away from you, right, at expiration. However, you can prevent that. You can simply go out there and you can exit the call and then sell a call further out. You're still going to make money. Covered calls are beautiful. And again, as an investor, I think everybody should be taking advantage of dividends and they should be taking advantage of covered calls. Okay? It's a basic income trade. It's something that everybody should do. Now, what I want to do is I want to get into something a little bit, in my opinion, easier and a little bit better because it's a lot cheaper. Now remember, this trade right here is going to cost you $14,000. I want to take this NVIDIA trade and I want to make it a little bit better and I want to make it a little bit cheaper. So here's how we do it. Now first, I want to take a look and I'm going to close this and I'm also going to open up now an option chain. Now, if you didn't know this, options have probability built into them. So I'm going to look at NVIDIA and I'm going to go out to November. As a general rule, when I trade my options, whether I'm doing covered calls, whether I'm doing a vertical credit spread, it doesn't matter what I'm doing, I like to sell options between 21 and 45 days. That's a baseline for me. Now, what I also like to do is I like to look at the probabilities. Now, the beautiful thing about probabilities are something that is built into every option, and it gives you an idea of what the statistical chances are of a stock being above or below that price at expiration. So for instance, this is the option chain of NVIDIA. You can see a 145 call right here. This is where the 145 is. And if I go out to the 145 call, there's an ITM for that option. It's called in the money. So what that says is there is a 34% chance that by November 15th, that 145 call will be in the money. That means there's a 36.2% chance right now, that's this one right here, 36.2% chance that by November 15th, NVIDIA will be above 145. That means there's a 65% chance, and I'm rounding here, that it won't be, right? So what I'm going to do now is I'm going to use that same probability. And by the way, that probability is not just an Options Pro thing. It's built into every options broker that I've ever used. Okay, there's always a probability calculator. There's a very easy way to determine option probability. Now, probability, by the way, is just based on the historic movement of the stock, where the stock's been in the past. So it's a really nice indicator that's really more of a, objective approach. You're not looking at an indicator, you're not taking your personal bias in there. It's just strict statistics, which I like. Now, when I want to make money in a stock and I think the stock is going to go up, I'm going to go back to a risk graph just to illustrate this. Do you remember what the covered call looked like on this trade? It looked kind of like this, right? Now, I ended up doing, I think, a 145, and you can kind of see this is what the risk graph looks like. If the stock goes sideways, I make money. Now, instead of doing a covered call, when I think a stock is going to go up, instead of this, I'm going to go out there and I am going to sell a put. So I'm going to go sell a put on NVIDIA. And right now the stock is at 136. Let's just illustrate selling a 136 put. Now, take a look at that risk graph. That risk graph is basically the same risk graph as you had with a covered call. It's not perfectly matching, but you get the idea. If the stock goes completely sideways, like right here and kind of right here in pre-market trading, this is where the stock is jumping back and forth to. If the stock stays completely sideways, right, I make money. If the stock goes down a little bit, I can make money all the way down to 129.05. Think about that. Stock's trading at 138. If I went out there and sold a 136 put on this stock, I can make money as long as the stock for the next 28 days stays above 129.24 and closes there. This is called a naked put, okay? And naked puts are great because it's exactly what they do. They give you an opportunity to make money even if the stock goes nowhere. Again, that's the goal of income trading, right? To create a situation where we can make money even if the stock doesn't go in our direction. Now, the naked put has some advantages. The advantage, of course, is the opportunity to make money even if you're wrong on direction. The downside of a naked put is, well, it's expensive. Now, I know every broker is different, but typically when you sell a naked put, you have to put up at least 25% of the stock's price. So in this case, the stock is trading at 136. You basically have to put up 25% of 100 shares of $136 stock. So it can be more expensive. Another downside is the risk. If something happens in NVIDIA and the stock opens up, and let's say it opens up at 115 for some reason, you're left with a very, very substantial loss down here to about $1,500. The most you can make on this trade is about $690. Okay, so if NVIDIA goes up, you let the option expire, in 28 days, you'll make $690, right? If something bad happens and NVIDIA goes down at 115, let's say, you may be forced to buy the stock because that's what your obligation is when you sell a put. When you sell a put as long as you have that position on, you may be forced to buy the stock at your strike price. Now, there are some traders out there that say, well, Ron, that's okay. I'm going to get the stock at a discount. It's trading at 130, or my puts at 136. Well, that's great. It's trading at 136. Right now it's trading at 138. Okay, great. But if the stock goes down to 115 and you have to take the stock at 136, even with that $6.90 premium that you're going to collect, you're still kind of at a disadvantage here, right? You're still at a disadvantage because you're going to get the stock for, basically $130 a share. It's now trading at 115. Now, yes, you can sell calls against it at this point, convert it into a covered call position, but you're really working from behind now. So if you're going to employ the naked put, and I don't have a problem with this trade. I think the trade's perfectly fine. Employ some sort of stop mechanism for this trade. You can make $690. Don't give up too much of that. It's as simple as that. Now, again, this is a great trade, but it does cost a little bit of money. So let's kind of move on to what my key trade is here. Let's convert this into a vertical credit spread. All right, now I'm going to go back to the option chain and I'm going to build a trade. Now here's what I like to do. I'm going to give you some hints along the way here. What I like to do is I like to build a credit spread that gives me at least a 60% chance of making money. So for instance, let's go out to our ITM column. If I take a look at the ITM, this tells me essentially what my chances of probability or my chances of success are. If I sell a 132 put, that gives me a 38% chance of that option being in the money. Okay? Now, as long as the option stays out of the money, I can win. That means if I have a 38% chance of going in the money, I have a 62% chance of staying out of the money, which is my goal. I never want the option to go in the money. So let's sell a 132 put. Now, I'm going to go ahead and put that onto a risk graph, just the naked put, just like we did before. Okay. Now, if you look at this, I can make $520. As long as the stock stays way above 126, I'm in good shape. But if it stays out of the money, I have no chance of being assigned. So as long as it stays above 132, I have no chance of being assigned. However, this does again cost money. You have to put up at least 25%. So what we're going to do is we are going to use the power of options to limit our risk. I'm going to go out there, I'll click Edit Spread, and I am going to go ahead and I'm going to buy an additional put. So I sold a 132. I'm going to go out and I'm going to buy a 128. Now, as soon as I do that in one transaction, this is what happens to the trade. I create a situation where no matter what happens, if the stock goes all the way down to $100 a share, okay, the most I can lose on this position is $267. That's it. That's the most I can lose. Actually, $265. My cursor was a little bit off. All I can lose is $265. That's it. Now, I've capped my gains. The most I can make is $135 as well. I'm limiting my risk. I'm fixing my profit. Now, here's the beauty of this trade. The trade cost is typically your max risk. I only have to pay $265 to place this trade. It's very inexpensive. It's very inexpensive. You can do this with a $5,000 account. Now, Ron, what if I'm trading a larger account? Well, go up here, I'll click on Edit Spread. What if I did this trade on 25 contracts? Now, I have the potential to make $3,300, risking $6,600. But here's the kicker of this. When you manage these trades properly, you're not going to risk that. You're not going to risk that amount. Because with an options trade, like any other trade out there, You're going to manage this position. Let's go back to a graph of NVIDIA. If you went out there and bought 1,000 shares of NVIDIA, are you going to tell me that you're going to go ahead and just hold this stock forever? I hope not. I hope you're going to set up some sort of a strategic stop for this trade to where if it goes against you, you're going to give up on it. Every investor should be doing that. They should be using some sort of a stop. At VectorVest, we have great tools for this. We have ProTrader. We have, RoboTrader. We have a lot of great stuff for this, right? We have a lot of great stuff to create stops. Use these tools. They are good for this. Now, what we're going to do as an option spread trader is we're going to use our option that we sold right here as our stop price. So as long as the stock stays above 132, we will stay in this position. If it drops below 132, we will exit the position. Now, I've been doing this type of trading for 15 years-ish, roughly 15 years. Might be even more than that, honestly. I lose track. I've been trading for 27 years, so I lose track of how long I've been doing certain things. I've been doing this with VectorVest now for almost a decade. And all of that time, I've never been forced to buy stock. I've never had a trade be assigned to me. So the fear of having stock assigned to you, really, as long as you're managing the trade, you don't really have that risk. It's very, 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 very low chance. And again, I've said over my 15 plus years of doing this, it's never happened to me. And the reason why it's never happened to me is because I exit the trade when it starts moving against me. The enemy for me as a vertical spread trader is in the money options. As soon as they go in the money, I exit. Right now, these options are all out of the money. Now, how do you know they're out of the money? I'll give you a little tip on this. Look at the deltas. An at the money option is 50 delta. An in the money option has a higher than 50 delta. Pay no attention to the negative. I'm just talking about the absolute value of the number here. If that delta were to rise above 50, that means the stock price has dropped below 132. Now, I'm going to open up my little data window here up in the corner, and let's take a look here. I want you to take a look in that data window in the upper left-hand corner. So right down here where it says October 18th, I want you to look at that number. Look at it right now. If the stock drops to 132, I will lose $1,346 on this trade. I can make as much as $33.75. Now I know what you're thinking. Well, Ron, what if there's a gap? Gaps can happen. One of the biggest reasons that we have option or gaps, let's go back to the graph of NVIDIA. Okay. One of the biggest reasons gaps happen typically is because of earnings plays, right? Earnings gap, earnings gap, earnings gap. Other than earnings, the stock doesn't gap a whole heck of a lot. It can move pretty fast. I mean, you look right here, it moved from 119 all the way down to 108 in one trading day. But the gap was very, very small. It gapped like $2 or $3 a share. So to avoid the gaps, to bring in our British friends, mind the gap, we would not trade near an earnings event, and we would never hold the trade to an earnings event. Okay? We're going to exit when the stock passes the short strike. Short strike being the option that we sold. That's going to limit our risk even more. Even if you do get a gap, the risk does not go up tremendously. Now, could you possibly lose $6,000 in this trade? Yes, you could. If all of a sudden, out of nowhere, the stock gapped down to 100, you could lose $6,600 in this trade. The good thing is you don't own the stock, so you're still not taking that big loss. It's not like a naked put where you're taking a substantially larger loss, right? You're still limited. And again, in 15 years, this has never happened to me. I've never taken a full max loss on any option trade that I've ever done for this type of strategy. It's a safe strategy. As long as you trade it properly, it's a really good way to make money. And in a lot of cases, we can even go and get more probability. Like if I wanted to go down to, let's say, 127 and trade down there, now I'm creating a situation to where I can make money even at a larger stage. And again, I cap the loss by buying a put a little bit lower. Now, there is going to become a time when that risk and the profits become too unproportional, when the risk becomes too large for the trade. You can see that this trade has a profit of $100, has a max risk of 300. Even if I go out and I say, okay, I'm going to exit this trade when the stock reaches 127 now. Well, from a probability base, I have a 31% chance of that happening. If there's only a 31% chance of that option becoming in the money, that means there's essentially a 69 or 70% chance of it not happening. I have a 70% chance of staying above that number. Now, if it goes below that number, I'm going to lose $85 on the trade. Now, that may sound kind of difficult, right? But I want you to look at some raw numbers here. I'm a text document guy, so I like doing this. I want you to take a look at this. Bear with me just a second as I pull up some numbers here. If I take that trade 10 times, and let's say the statistical probability works, I win 7, I lose 3. If I make $100 7 times, that's going to be $700 in profits. If I lose $80 3 times, I'm going to lose, where's my equal sign? $240. Even then, it is still a good trading opportunity. So that risk reward kind of balances itself out. It's one of the things you're going to look for in a credit spread. Okay? So just again, as we go forward here. So with the vertical credit spread, number one, create probability. I like to create my trades with a base level of a 60% chance of success. Now that's based again on statistics. Risk. As a general rule, if you're going to do this and you're going to try this on your own, keep your trades like you just saw with NVIDIA to about a 3-to-1 risk or better. And you just saw that. Now again, I'll go back to the risk graph just to show you this. The risk on the trade is a maximum of $300. You can see it right there. The maximum profit is $100. Okay? Now, my probability is 31% chance that it goes against me, 69% chance that it wins for me. Okay? So there's your probability and there's your risk. Now, the probability, it's a fixed number. Again, most brokers have this. Of course, our tools here with Options Pro at VectorVest are fantastic for this. Risk, you just have to set the trade up. What's going to happen is when you buy your insurance leg, the closer you buy your insurance leg, the less risk you're going to have, the wider the spread. So if I go back to that example, I had a $4 spread. If I were to create, let's say, a $6 spread, you're going to see that the risk goes up $4.59, as does the credit. But you're going to want to make sure you monitor and maintain that risk and that profit. If you can do this, finding good stocks with VectorVest, this is an awesome way to create income. It's something that we've been doing here at VectorVest now for a decade. I run a coaching group, the Ultimate Retirement Solution Coaching Group. We do this every week using these types of trades. Now, if this is something that you're interested in learning the full details of, we are launching another Options Paycheck experience in November. We've been doing this class now at VectorVest for 9 years. It's been extremely popular. I'd love to have you for our November, December class. And just to give you an idea of what the class is, it's 8 modules long. We're going to teach you everything from option basics in module 1 all the way out to entering your orders with brokers and everything in between. It's a full 8 module course teaching from basic options, finding the right stocks, teaching you the spreads, understanding risk, volatility, earnings issues. We're going to teach you everything that you need to know about these vertical spreads. It's the most comprehensive options training program out there. We also offer a money back guarantee. Take the course, give it a try. Even if you've never traded options before, you have that out. Just notify us within a week of ending the class and you can get your money back. It's as simple as that. We have a great offer for you. You get the complete option training program. That's 8 training modules. So the class lasts for November and December. We do live presentations in November to teach you the 8 modules. And then in December, we actually will live trade with you. You'll be invited to my coaching where we implement this every week, show you how the trades work, show you the trades that I'm taking, show you how to manage them. You're going to get everything you need. For the month of November and December, including in our mastery package, we're going to have 3 live sessions a week. These are sessions where when you watch the modules on your own, you come in there, you get me, you talk to me about any questions you have, any concerns you have. We want to make sure you understand things. We record everything that we do, so if you can't view the live curriculum with us, it's okay. You can simply watch the recording. If you don't have the Options Pro software, we're going to give you a trial of that from November until the end of the course in December. And, you're going to have everything that you need. We also do an SPX paycheck system on this. So if you're worried about doing this on stocks and finding stock opportunities, then we can help you just do this on the S&P. It's one trade. It lasts for no more than 15 minutes of placing that trade. And the typical trade is about 2 to 3 days long. It's really something that can fit any investment type, whether you have a $5,000 account or a $150,000 account to trade these options are. The beautiful thing about the credit spreads is they are very, very simple and they are very, very cost effective. Now, if the course is something you're interested in, we're going to run a special promotion here for the strategy of the week. If you order the course before 6 p.m. Eastern time on Monday, we can do it for $9.95. I would also encourage you, if this is something you're interested in, but you still want a little bit more information, I would urge you, come to one of our free sessions on Monday. If you take a look at the live events section of the VectorVest website under education and events and webcasts, on Monday at 4:30, we have a how to generate 3% per month with one option trade per week. And any of our classes this coming week, if you want a little bit more information, sign up, register. This is a very critical component of creating a good income stream. So again, if you're ready to order, go to www.optionspaycheck.com, get yourself registered for $9.95 for the Strategy of the Week promo. Again, you have a full money back guarantee. The onus is on us to prove that we can teach you how to create income using options. Thank you again for attending tonight's special presentation. I look forward to seeing you in our Options Paycheck course. Good night, everybody.